Hello everyone, welcome to Global Online. In today's lecture, we are going to see NTA UGC NET Paper 2 Commerce 2022 batch, and this one is a third lecture of unit number 10, that is income tax. In today's lecture, we are going to see about the salary income and the important concepts which are there in the unit number 10. Okay. Before we start with the lecture, I want to tell you that we the Global Online providing the course for the paper 1, in which we are providing you the daily life lecture, notes on all the topic, last 10-year question papers with a detailed explanation, test series covering 2500 MCQ with the detailed explanation. To get this, download our app Global Online or WhatsApp on this number. Okay, and the fees for this is 3500 rupees only. Students, we are also providing course for the UGC NET Commerce Paper 2, for which you have to download our app, that is Global Online, from your Play Store. Once you download the app, you have to register your number and go in the store and search for the UGC NET Commerce Paper 2. In this course, you are getting the complete video lectures on all the unit, notes on all the unit, test series, plus the previous year question papers with a detailed explanation and target based preparation. And if you are taking this course, the paper 1 you will get the free of cost. No need to buy the paper 1 separately. Okay, and the cost of this course is 7000 rupees only. Salary. When we say salary or when we heard the word salary, what comes in your mind? Salary means something which we get after we work, right? The money which we get after working. So here under the income tax unit, the salary is given under section 15 to section 17, which you have to remember here. A salary is a remuneration received by or occurring to an individual periodically for the service rendered as a result of express or implied contract. The actual receipt of salary in the previous year is not a material as far as taxability is concerned. Here the salary is the remuneration which the individual get after he work for certain period of the time. Salary is paid periodically. For example, if there is a one person who is working in a company or who is working in some office, he will get his salary after 1 month. Okay, whatever money he is getting, that is called a remuneration, that is called a salary. According to the Income Tax Act, there are a certain conditions where all of such a remuneration is chargeable to the income tax. Whatever salary the individual is getting, whatever salary the assessee is getting, that salary is chargeable to the income tax under the head salary. For this, there is a certain conditions. The first one is when due from the former employer or a present employer in the previous year, whether the paid or not. Second one is when paid or allowed in the previous year by or on behalf of the former employer or a present employer, though not due or before it become a due. And third condition is when the arrears of the salary is paid in the previous year by or on behalf of the former employer or a present employer if not charged to the tax in the period to which it relate. That means whatever salary you are going to receive in the previous year, on that salary you have to pay the tax in the present year or in the assessment year, and you have to remember this condition here. Section 17 Clause 1 of the Income Tax Act give an inclusive and not exclusive definition of the salary, which include, now here what different things can be included in the salaries is given. The wages, whatever wages we will get, that will be included in the salary. Then is an annuity or a pension. The pension which the individual will get after his retirement, that will be included under the head salary. Then is a gratuity. Then is a fees, commission, allowance, perquisite or a profit in a lieu of salary. Then is advance salary. If you are receiving the advance salary, that will be come under the head salary under the Income Tax Act. Then is amount transfer from unrecognized provident fund to the recognized provident fund. Then is contribution of the employer to the recognized provident fund in a excess of the prescribed limit. There is a certain provident fund which we call the PF in the company. If the person is working in a company, the person have to fill that form while joining the job. That is provident fund which he will get after his after he leave the job or after 6 months. Then is a leave encashment. Then is compensation as a result of variation in the service contract and the contribution made by the central government to the account of the employee under the notified pension scheme. All these things will be included under the head salary in the Income Tax Act. Then is areas of the salary. Now what is areas of the salary? Salary in arrears or a advance receiving a lump sum is liable to tax in a year of a receipt. Relief can be obtained from the salary arrears under section 89 clause 1. Please remember the section here of the Income Tax Act. Here whatever salary in arrears we receive or whatever salary we receive in advance, maybe it will be a lump sum amount or a small amount. On that amount we have to pay the tax in which year we have received that salary. Okay. Then is a pension. Now what is pension? Pension is the payment made by the employer. Who is making the payment? Payment is making by employer after the retirement or a death of the employee as a word for the past service. It is normally paid as a periodically payment on the monthly basis, but certain employer may allow an employee to forgo a portion of a pension in a lieu of lump sum amount. So here the pension is the amount which the employee will get after his retirement. For example, supposing you are the government employee who is who is providing the service in the government department. After the certain age, it is 60 or 58, after that age you get retired, right? So after your retirement you will get a pension. It is on the monthly basis, right? Or if supposes if the person died on service, then even he will get the pension on the monthly basis. Now there is some employer are there who is giving this pension on the lump sum amount after on the date of retirement. Okay. Then it's committed pension. For employees of a government organization or a local authority and a statutory corporation, it is fully exempted from the tax. Whatever amount they are getting, it will be fully exempted, where they don't have to pay any tax on that. Hence not included in the gross salary. Okay. For the other employee, committed value of a half of a total value of a pension is exempted from the tax. Supposing the person is not a government employee and he is getting the pension of the 10,000. So here he have to pay the tax on the 5,000. Okay, on the half amount. Any amount received over and above this amount is taxable, so included in the gross salary. If, however, the employee is also receiving the gratuity, means the another retirement benefit along with the pension, then the 1/3 of a total value of a pension is exempted from the tax. The amount received in excess of this is taxable, so included in the gross salary. Okay. So pension received by the employee is taxable under the head salary. However, the family pension received by a legal hire after the death of an employee is taxable under the income from other source. Means here after the retirement of an employee, if he is receiving the pension, that will be coming under the head salary in the income tax. But if the person is died and his family is getting that pension, that time that amount will come under the income from other source. For a central government employee joined on or before 1/4/2004, the 10% of a salary is compulsory deducted towards the pension with the matching contribution from the government and the non-taxable under section 80 CCD. Here you have to remember again the section. Only the terminal benefit is a charge to the tax. Valuation of medical facilities. Medical facilities provided to the employee are exempted from the tax. Now, which different medical facilities are there which can be exempted from the tax? So, first one is medical benefits within the India which are exempted from the tax include the following. So, what different benefits are there which is provided in India and which we can exempt from the tax? First one is medical treatment provided to an employee or any member of a family in the hospital maintained by the employer. Here, if supposing the employee is getting a treatment or his a member or supposing his a wife or his a children is getting a treatment in the hospital which is provided by his employer, that time that treatment will be exempt from the tax. Second one is any sum paid by the employer in respect of an expenditure incurred by the employee on the medical treatment of himself and a member of his family in the hospital maintained by the government or a local authority or approved by the government for a medical treatment for the employees. And second one is in the respect of the prescribed diseases or a alignment in any hospital approved by a chief commissioner. And third one is the premium paid by the employer on the health insurance of the employee under the approved scheme. Premium on the insurance of the health of an employee or is a family member paid by the employer limited exemption. So again here there is a limit for the exemption. If the ordinary medical treatment of an employee or any member of a family is done at any private hospital, nursing home or a clinic, the exemption is restricted to the rupees 15,000. So here if supposing the employee is getting his treatment in a private hospital, that time he will get the exemption, but it is having a limit of 15,000 here. Just now we talk about the medical treatment in India. Now supposing the medical treatment outside the India which is exempt from the tax, which different things can be included here? The first one is any expenditure incurred by an employer on the medical treatment of the employee or any member of his family outside the India, that will be exempt from the tax. Then is any expenditure incurred by the employer on the travel and stay abroad of a patient and one attendant who accompanies a patient in connection with such a treatment shall be exempt to the following extent. That is, the first point under this is the expenditure on medical treatment and stay abroad shall be exempt to the extent permitted by the Reserve Bank of India. And second point here is the expenditure on travel shall be exempt in full provided the gross total income of the employee does not exceed the 2 lakh of amount. So here is a exemption limit, that is a 2 lakh. Valuation of rent-free accommodation. For the purpose of valuation of the house, employees are divided into the two categories. The central and the state government employees and other employees, means the non-government employees. The central and the state government employees, if the accommodation is provided by the state or a central government to their employee, the value of such an accommodation is simply the amount fixed by the government in this regard. Here the government will fix the amount for the accommodation. And other employee, the valuation of accommodation of this category of non-government employee depend upon whether the accommodation is given to the employee, is owned by the employer or taken on the lease. So it is depend whether the employer is providing such an accommodation or it is on the lease. Okay. Accommodation owned by the employer in the cities having a population exceeding a 25 lakh as per the census 2001, 15% of a salary less the rent actually paid by the employee. Okay. If the population is exceeding the 25 lakh, then only. In city having a population exceeding a 10 lakh but not exceeding the 25 lakh, in that case the 10% of the salary less the rent actually paid. And third case is other than this place, means the city is having a population 25 lakh and the city is having a population is 10 lakh. Other than this cities, 7.5% of the salary less rent actually paid by the employee will be given as a accommodation. Here the accommodation is taken on the lease or a rent by the employer. The rent paid by the employer or a 15% of the salary, whichever is a lower, less the rent recovered from the employee. Here the whatever rent is paid by the employer, supposing here the employee is paying the rent of a 10,000, okay, or a 15% of a salary. Supposing the 15% of a salary is getting a 15,000, okay. So here whichever is lower. So here in this case the 10,000 will be considered as an accommodation less the rent recovered by the employee. Accommodation in the hotel, 24% of a salary paid or a payable or a actual charges paid or a payable, whichever is a lower, less the amount paid or a payable by the employee. That will be considered as a accommodation in the hotel. There are some important concepts under this unit which you have to understand. You have to just understand the meaning of this because you might receive the question on this. Okay, that is a tax evasion, tax planning and a tax avoidance. If you look at the previous year question paper, you will be definitely find a question on this type of a concept. Okay, you will receive the question on only on the concept. So please clear this concept in your mind. First one is tax evasion. When a person reduces a total income by making a false claim or by withholding the information regarding his real income, so that is a tax liability is reduced, is known as a tax evasion. Tax evasion is not only the illegal but it is also the immoral, antisocial and anti-national practice. Therefore, under the direct tax law, the provision have been made for the imposition of heavy penalty and institution of prosecution proceeding against the tax evaders. Tax evasion is a illegal process, okay, and it is a false claim which is made by the taxpayer. If the one businessman is paying a tax and he don't want to pay the more tax, okay, so to reduce that tax, what he is doing, he is making some false claim. He is showing some wrong amount there. Okay, he is not showing the actual amount. So it is a illegal. It is not a legal. Okay, and we also say it is a immoral or a antisocial or a anti-national practice. So this is called a tax evasion. Then is tax avoidance. What is tax avoidance? The avoidance means where we are trying to avoid the tax. It is an art of dodging the tax without actually breaking the law. It is a method of reducing the tax liability. Now, how we are avoiding this tax? So here, the Royal Commission of Taxation for the Canada has explained the concept of avoidance of a tax as the expression tax avoidance will be used to describe the every attempt by a legal means of prevent or reduce the tax liability which would otherwise be incurred by taking the advantage of some provision or a lack of a provision in the law. It excludes the fraud, cancellation or a other illegal measure. So tax avoidance is legal and not illegal. Okay, here we are not doing a fraud or any other illegal things. Here we are just trying to take advantage of some provisions which are there in the law. Okay, so here we are trying to avoid the tax. Here we are trying to reduce the tax with the legal things. Then is a tax planning. What is a tax planning? In tax planning, it may be defined as an arrangement of one financial affair in such a way that without violating any way the legal provision of the act, full advantages is taken from all the exemption, deduction, rebate and the relief permitted under the act, so that a burden of a taxation on the assessee as far as possible the least. While filing the income tax return, what that person is doing who is filing the return is trying to take more and more advantages where more exemptions can be taken or a more deduction can be taken. He's trying to take all the possible things so that the tax burden on the assessee can be reduced as far as possible. Okay, here we are doing the planning. Here we are not avoiding. Okay, I hope all these things are clear to you.